Hello and a very warm welcome to this Scope Ratings webinar. Is Germany at an inflection point? Post-election implications. My name is Keith Mullin and it's my pleasure to be your moderator on today's session. Now, the simple question we posed as today's title, whether Germany is at an inflection point, is a loaded one in so many ways, and it's certainly one that requires thoughtful reflection and analysis, which is why I'm so delighted to have on the session today three members of Scope's Sovereign team who have done some hard thinking and come up with some perspectives that I'm sure you'll find insightful. So let me introduce Alvise Lennkh-Yunus, Eiko Sievert, and Julian Zimmermann. Morning, gentlemen.
Morning.
Now, in a moment, they'll take you through a presentation with some of their thoughts in the wake of Sunday's federal election results. Elections that were conducted, we scarcely need to be reminded, amid not just heightened geopolitical uncertainty, but also potentially fragile domestic and European growth and credit outlook with a lot of moving parts. But now the focus shifts to the new government's political, economic and fiscal policy priorities, which we need to be swiftly laid out and needed acted upon in the short term. Now, as we examine the challenges facing the new German government, we'd like to make today's session interactive. So I do encourage you to ask questions utilizing the questions function on the platform here so we can get to them as we go along. Now, today's presentation is split into three separate sections. And as each of our speakers concludes their portion, I'll jump in and put some questions to them and some of your questions if as appropriate. We'll also have time for a Q&A session at the end. One last thing from me, today's slide presentation will be available for download at the end, and I'll explain how to do that later. So let's get started. Eiko, I believe you're going to kick us off, so let me hand over to you.
Great, thank you very much, Keith. So I'll get straight into the slide deck. So clearly, I have to start with brief highlights from the election nights. Now, the only realistic coalition option at this stage is the CDU-CSU with the SPD. And it's clearly helpful that the CDU-CSU is able to govern with only one coalition partner. And it reduces the risk that Friedrich Merz will face a sort of difficult political infighting that his predecessor had to deal with over several years. The fact that we have this coalition option is thanks to the results of the new BSW party, staying just below the required 5% threshold to enter parliament by a really very thin margin of just 0.03% of the vote. If they had exceeded the 5% threshold, we would be talking about a three-party coalition today, also including the Greens, because that would really be the only option for the CDU under those circumstances. And the second important result from the election is that the three centrist parties, so those being the CDU-CSU, the SPD and the Greens, miss the 2/3 majority that's needed for constitutional change. So this was again by a very thin margin of only 3 out of 630 parliamentary seats. But it does mean that any legislation that requires a 2/3 majority will therefore depend on support from either the far left, so the Linke Party, or the far right, the AfD. And this is particularly relevant if the new government wants to make any changes to Germany's constitutional borrowing limit, known as the debt brake, or if they want to agree on new so-called special funds that allow additional borrowing outside of the debt brake limits. And there's one final important point that's sort of directly related to this. So for now, the centrist parties in the outgoing parliament still hold a clear majority. In principle, this opens the door to either change the debt brake or agree to a new special fund within the 30 days before the new parliament sits for the first time, which is basically roughly the end of March. So Friedrich Merz is exploring exactly this option at the moment. Clearly, it could be seen as anti-democratic by some, and it could also face legal challenges potentially. But it may be the only option for him to materially increase defense expenditure. But we'll talk a little bit more about this later in the presentation as well. So what you see here is a table showing various policy proposals that were discussed during the election campaign and the colors indicating the stance of the parties to these proposals. Naturally, the CDU, CSU, and SPD are not aligned on everything, but we are pretty confident that they will be able to find common ground on the key areas during the coalition talks. And I'll touch on many of the points in the table in the next couple of slides as well. But before I do so, I also want to highlight why economic growth, including these policy reforms, must take center stage for this new government. And there's clearly plenty of uncertainty this year, but our current forecasts imply that the German economy will be roughly the same size at the end of this year as it was at the end of 2019 before the pandemic. So as a comparison, France, Italy, Japan, and the UK will be around 5% bigger. Spain will be 10% bigger, and the United States will be 15% bigger. Also related to this weak economic growth, Germany has clearly been falling behind on international competitiveness rankings over the past couple of years, especially following the sharp rise in energy prices. Looking beyond 2025 on the chart, you can see Germany's growth path if it grew by 0.5%, and then also if it grew by 1%, which is roughly the country's growth potential, depending on how optimistic you are about the implementation of possible reforms. So quite clearly, catching up to other large developed economies, at least looking back to since 2019, will be quite difficult, but it does underline the importance of why Friedrich Merz's government really does need to focus on boosting economic growth in the next couple of years. So let me dive into some of the policy reforms that could help kickstart growth. First, let me start with two topics where we have agreement between the likely coalition partners. So the first is on energy. Gas prices for industrial consumers are roughly 5 times as high in Germany as in the United States. And this compares to prices being about 1.8 times as high as in the US before the COVID and energy crises. Clearly, the new government cannot control global gas prices, so lowering these will be quite difficult, although there has been some progress to help reduce demand for gas within Germany. Electricity prices, which you see in the chart here, I highlight Germany in the red quadrant, and you can see the United States with significantly lower prices in the green quadrant. And here the government could lower prices somewhat, in particular by lowering taxes on electricity, and also by funding part of the network upgrades for the energy transition through public funds. In principle, this could be done through so-called financial transactions, and in that case, it could even be done under the current debt brake framework. One point that's worth noting here is that high electricity prices in Germany are nothing new, and the country would be at a similar place in this chart if I go back 10 years. And the reason why such high energy prices are increasingly becoming a problem now is because we are seeing significantly stronger competitiveness from key German export markets such as China. And at the same time, German exporters are also clearly facing the deglobalization trends that we've seen intensifying recently. This is also the reason why the new government will have to prioritize an industrial strategy that perhaps also encourages an even greater focus on sort of high value added products. And then next, we have the long-standing topic of reducing bureaucracy. So pretty much all political parties agree that we need to reduce bureaucracy, even if there are some disagreements on how best to do so. And the right-hand chart just gives an indication for the ease of doing business across different countries. And you can see Germany in the lower half of the ranking, while the United States, for example, is in the upper half. Important to note here clearly is that we are seeing this very strong deregulation drive in the United States. So perhaps the US will shift higher along on this chart as well. Also important is the fact that we do see other EU countries with a significantly more friendly business legislative environment than in Germany, and even than in the United States. So while improvements in EU regulation clearly are very welcome, there's no need to wait for changes at EU level to take action domestically in Germany as well. Next on my list are labor market reforms and also the demographic shift in Germany. So labor market reforms will be important to improve productivity, especially given Germany's demographic challenge that is really putting downward pressure on the country's growth potential. And I don't mean in the distant future. The left chart shows that Germany faces a declining working age population over the next 5 years already. At the same time, Germans work fewer hours on average than in many other European countries. So I'm not trying to say here that Germans are lazy, but it is a reflection of, for example, the availability of kindergartens and school programs that often result in one parent either working part-time or stepping away from their job entirely. And so more investment in education, for example, could therefore help raise participation, particularly among women. The chart on the right also tries to highlight just how crucial migration is for Germany. Over the next decades, the working age population is set to continue to decline sharply, not just in Germany, also in Italy and Spain, as you can see here. And migration has been a hot topic during the election campaign. And I would just stress that if we want to see higher growth in Germany, then any efforts to limit migration must not discourage skilled migrants from coming to the country. A key priority must also be to make it easy for migrants to join the labor force. So both in terms of, for example, recognizing their foreign qualifications or making it easy to navigate the relatively high bureaucratic hurdles in Germany to get registered. And finally, more focus also on supporting reskilling of workers will be important, especially if we see some of the more energy intensive production because of the high energy prices shifting to other countries. Tax policy. So this could also play an important role in supporting stronger economic growth. Corporate taxes are high in Germany at about 30%. In fact, this is one of the highest rates in the OECD, only really exceeded in Portugal and Colombia. The rate also hasn't really shifted in the past decade, while most other large developed economies have reduced corporate tax rates over this time. There's one exception here in the chart, which is the United Kingdom, but I have to point out that here the corporate tax rate has historically been relatively low compared to other countries. And while clearly lowering corporate taxes is not a silver bullet to solve Germany's growth problems, lowering the rate can make a contribution by supporting business investment. And in terms of total government revenues, corporate taxes make up a relatively small share of around 5 or 6%. And some estimates suggest that lowering the tax rate to 25% could raise GDP by around 1% in the medium term. And then some reform on the income tax side could also help. So at the moment, in an international comparison, it's relatively expensive for businesses to hire workers in Germany, as the take-home pay compared to the salary paid by the company is quite high. And the chart on the right shows this tax wedge for singles with no children. If I showed you the same chart for married employees with children, Germany would be a bit further towards the right. But still, given that many young, innovative startup type of firms may rely on workers that also happen to be single, some targeted income tax reform here could be beneficial to encourage more private sector investment. Now, I don't want to spend time summarizing everything that I said, but you see the sort of broad highlights here. I just wanted to maybe quickly point out two more things that also happen to come up on this table. So the first is, what about restarting nuclear power in Germany? So this has been much debated over the past couple of years. In principle, it can help to lower energy prices to some degree, especially if existing power plants could simply be restarted. But we shouldn't pretend that this is a simple solution that will solve Germany's high energy costs. At the peak, at around sort of 1999, nuclear power made up 12% of energy consumption. By just before the pandemic in 2019, it was around 5% of the energy mix. So return to nuclear power can maybe help to some degree, but I don't see it solving the the high energy prices, at least in the short term, especially as construction of new nuclear power plants does take quite a long time. The second point I just wanted to very quickly mention before I finish is on incentivizing people to work beyond retirement age. So given the aging population that I previously highlighted, these kind of policy changes, whether encouraged through tax-free allowances or other measures, could be implemented relatively quickly, and they may also ease to some degree the pressure on future government budgets. So I know I covered quite a few policy areas, and I hope this also underlines that there's no single simple solution for Germany's weak growth. It really requires a pretty broad policy approach from the next government to create sort of an environment where businesses want to invest more and where we also see higher productivity per worker. So overall, I guess to sum up, I would be cautiously optimistic that the two future coalition partners can come to an agreement on most of the important policy priorities that I've just mentioned.
Okay, yeah, thanks. I guess we can always hope, right?
Absolutely.
Look, you covered so many areas there that each of which we could go into in some detail. But one thing I guess I did want to ask, I mean, you talked in the previous slide about demographics, and you also talked about extending the working life of workers, as well as migrant integration. But one thing I did want to ask you about was pensions, and I guess two questions. First of all, do you think there's a need for pension reform? And I guess more poignantly, do you expect the new government to actually address it?
Sure. So Germany has a pay-as-you-go pension system, so where pension payments are funded through the regular budget. Other countries like Finland have similar systems, but they've built up large pension reserves over the past couple of decades. Unfortunately, Germany has not done so. And at the moment, pension contributions make up roughly a quarter of the German budget. And some estimates suggest that this, without any reform, this share could double by 2050. So we haven't really seen any significant reforms during the last government. So there were no cuts to pensions, no increases in contributions, not really any new changes in the retirement age. And there was an idea floated about introducing an equity-based pension system, or in German, they call it Aktienrente. So that would have essentially borrowed funds on the financial markets, invested these in the stock market, and the net gain would essentially then be available to support the pension system. And I mean, this type of reform can provide some relief in principle, but it's really too little too late, and it's not really going to materially tackle the issue. And I think ultimately spending half the budget on pensions, to me, looks difficult. So eventually, I think some changes will be needed, especially with the big defense and infrastructure investment pressures that not just this government, but future governments will also face. While I'm not expecting too much progress on pension reforms from the next coalition, simply because of these other areas that are perhaps more in the limelight, I do think some reform will be needed at some point. And of course, I'm very happy to be proven wrong, and perhaps this government will come up with a surprise. But during the election campaign, the issue hasn't really sufficiently been approached, in my view.
Yeah. Yes, okay. Yeah, thanks for that. Look, at the beginning of my introduction, I said that the question that we posed overall about whether Germany was at an inflection point, I said it was a loaded question. Now, given all the kind of reform ideas that are out there, and I guess a lot of them were articulated during the election campaign, I guess do you think Germany is at an inflection point? Do you think that the reforms will actually lead to stronger economic growth, as you alluded to at the very beginning? It's quite poignant, the differentiation between Germany and other economies on growth. I mean, we can't tell the future, but what are your kind of thoughts about about where we stand today and your level of optimism about growth.
So, I mean, in terms of Germany being at an inflection point, I guess in some areas, so for example, defense spending, you could probably argue, yes, there is a significant shift compared to the past. But let me put it this way, if all the topics that I briefly touched on now are actually addressed, then I would certainly expect stronger growth compared to the last 5 years, which admittedly is really a low bar. But I would expect a little bit more growth over the next years. The biggest drag on Germany's growth potential is the demographic pressure. So without migration, we would already have a declining population. So I think striking the right balance on immigration policy is very important and not easy, because clearly voters' concerns have to be addressed. But Germany also has to be as attractive and open to skilled migrants as it can be, also from a societal point of view. So more skilled migrants may mean more competition when looking for jobs, but these migrants will ultimately also pay for future pension expenses. And then maybe very briefly, also creating an environment to encourage private sector investment is also clearly important, but Germany doesn't have a particularly good track record in public investment as well. And clearly, there is a big question of how all of these proposals, some of them that I've also outlined, can be funded. But perhaps we can dig into that a little bit more. And then, so just to sum up, do I think this is sort of the next Wirtschaftswunder? I'm not entirely convinced yet that we are facing a sort of the next economic miracle for Germany. But there's certainly a chance for this government to return Germany back on a path of economic growth.
Okay. Perfect. That sounds like a good point, Eiko, to perhaps move to our next session, and perhaps we'll come back to some of the points towards the end. But I think, Julian, you are up next, so let me hand over to you.
No, thank you, Keith, and thank you, Eiko. I think Eiko would just pose exactly the right questions that lead to this very important issue, and that has been central both in the election campaign, but will also be central in the coming weeks with government formation and then the first budget that needs to be passed for both 25 and 26 still this year. So the question that Eiko essentially posed is, how can these growth measures be financed within the context of Germany's debt brake, and whether we expect any growth impulse from fiscal policy in the near and medium term. So I think very relevant questions that I want to spend some minutes on. Eiko also mentioned the special fund for defense that first appeared this week, essentially on Monday, where the SPD, Green, and CDU, CSU parties in principle seem to agree that there's a spending need to be addressed on defense. And then one of the ways to address this is to enshrine within the constitution another defense special fund. But I'll get to some of more details in just a second. Before I go to that special fund, but also some other debt brake reforms that are on the table, we did want to take a step back and have a look at exactly the challenge Eiko mentioned on public investment. It's no secret that fiscal constraint and the binding debt brake that we have seen since 2009 is contributing to a significant investment gap in Germany. So this is what you see on your screen on the left-hand side, where we show a public sector investment net of depreciation over the last 30 years. And what you can quite clearly and quite quickly see is that when you compare Germany to some other big economies, including France, the UK, and the US, but importantly also highly rated peers on the very right, you can see that public sector investment has been largely flat at around about 0%. So any physical infrastructure stock that had existed in Germany entering the 90s and 2000s has merely been maintained by the public sector. So you can think of bridges, roads, railways, and tunnels and the like, whereas other countries actually managed to significantly expand their stocks. So we tried to put this into one easy number just to have one, and we a few years back we calculated the investment gap, which is essentially the money Germany would need to spend to catch up to the investment level of the public sector in highly rated peer countries. 400 billion is a big number, even for a big economy such as Germany. That's 10% of GDP. So the challenge here is sizable. We do think that if there is a driven investment drive and a clear commitment by the coming government to address this, we think that this investment gap can be addressed, or at least partially addressed in a couple of years. Obviously, this is not something you can fix overnight. That goes without saying. So if you bring that back to the growth question that Eiko posed, can we actually increase growth potential up to 1%, which would lead Germany to converge closer to some other peer countries? We think this is an important piece of the puzzle, and you can see that on the right-hand side of your screen, where we try to show the correlation between public investment on a net basis and annual potential growth. Obviously, this is not a one-to-one causal relationship. We all know that it's more complicated than this, but we do think that it would be an important contributing factor to have Germany converge to its peer countries. This is in particular the case if this public investment crowds in private investment as well. So I think if we agree in principle on the investment gap and existence, obviously the number is quite difficult to pin down. The next question we find ourselves faced with is how to finance it. And if you have followed German public finances for some years, as we have done, I think you will have observed that this has become increasingly tricky to do so. This is exactly the reason why the previous government, in fact, collapsed. So in November of last year, the budget was still not found for so the amending budget for 24 was still not found, and the 2025 budget had been drafted by the government. And essentially, the three coalition partners could not find consensus to find even relatively moderate sums for policy priorities, but also at the same time stick to the debt brake rule, which is ultimately why Finance Minister Christian Lindner stepped out of the coalition. Someone else who has clearly recognized this challenge seems to be Friedrich Merz, but also politicians in the Green and SPD parties. And this brings me back to the special fund for defense that Eiko had mentioned when we started this recording, which is apparently what will, at least in the near term, be the most likely option to increase financial flexibility in the budget. The number that we have seen is 200 billion euros, which is quite a sizable top-up. So there's an existing fund of 100 billion euros until the end of 26, and that potentially will be topped up to 300 billion euros, which is an increase of 4.7% of GDP, so quite a sizable impact for sure. Again, this is at the discussion stage, so we will have to wait and see if this is actually implemented. What we also try to do is bring this back to the growth challenge. So what growth impulse we could expect from such a vehicle. Overall, we think this is rather moderate, and this has to do with the simple fact that much of German procurement, when it comes to military investment, goes to the US, but also Israel and some other countries. So the fiscal multiplier domestically will likely be lower than 1. But obviously, there could be still a sizable growth impact for the German industry, defense industry, which is a big one, the largest one in Europe, in fact. So if we accept the fact that this is probably the most likely option near term, we think there is a second best or a contingency option available to Friedrich Merz if this were to fail to happen in the next 30 days, which is to revert back to the simple majority to implement an emergency case within the debt brake. So that was more common during the COVID years, had been less common in this and last year. So outside of these two options, which I think fix the near-term defense issue to an extent, that we wanted to talk about briefly about two more options on the negotiation table, at least in the medium term, if not in the near term, and that is to increase the borrowing limit for either the lender or the central government. So the debt brake currently limits this to 0.35% of GDP. The numbers we've seen is to increase this to up to 0.7% of GDP, or give the lender some room. So they currently have 0. We think growth impulse from this would be rather limited. And this has to do with the fact that A, this is untargeted spending. So this is just an increase in the deficit. And B, if you were to give some to the lender governments, we all know that some of them are very conservative fiscally speaking and probably will not use the full allowance. So rather limited impact here. Finally, and everyone who's been following the debt brake knows that this has been around for some years. There's debate whether to reintroduce a golden rule, which is essentially would be a favorable investment treatment and would allow the federal government to borrow if it uses those funds for investment purposes. If that were implemented, the impact would be potentially quite large. So the government was due to spend 80 billion euros on investment this year, which is 1.8% of GDP. So if, that would immediately free up room in the federal budget. And for that reason, we also see a relatively high growth impact from such a reform. Now, speaking about higher deficits, higher borrowing, and higher spending, the question is, of course, very quickly, what does it mean for German credit quality, and German fiscal space? And this is what we try to show on the right-hand side here. In an international context, Germany still enjoys a low debt ratio, so roughly 60% of GDP, compared to much higher debt ratios in France, Italy, and some other countries you see on the chart. Of course, it is moderately higher than in some other AAA-rated countries. But we still think that there is fiscal space in Germany, especially if those funds were to be used for investment purposes. We have tried a simple simulation calculation where instead of the deficits that we saw were projecting in December, if you were to increase these moderately by 0.5% of GDP, the debt to GDP ratio would stay largely stable at 62% of GDP. So again, the numbers are really for illustrative purposes, but I think the message here is that there is fiscal space, and that fiscal space only increases if it leads to more investment on the public and private front. Of course, the numbers could be bigger near term if such a defense fund were implemented, but I think even a near-term uptick in the debt ratio would not, let's say, be at conflict with our base case for the German credit. Let me also sum up very briefly and not really repeat, but rather give you our flavor and base case. So essentially, we do see increased appetite to loosen fiscal policy in Germany to an extent. We think that near term, this will likely lead to higher defense spending. But I think medium term, there's also on the table the two other options I had mentioned to address other issues, and those really pertain to the public investment gap and infrastructure investment. And finally, we do believe that there is some fiscal space available. Of course, that is higher if it leads to higher investment. So yeah, let me close here, and maybe there's interesting questions from the audience as well.
Yes, in fact, thank you very much for that, Julian. Yeah, there are some questions. So just in no particular order, you talked about a public investment gap. One of our viewers has asked a question about private capital mobilization, because clearly it's not just about public investment. And given that Merz is seen as pro-business, the question says here, and has strong connections with the financial services sector, to what extent will he look to mobilize private capital to aid spending? And and it's just not about defense, but also infrastructure and energy. And then in references here, the strong insurance, asset management, and banking footprints in Germany.
I think that's an interesting question, and it's also loaded with many elements. I'll try to narrow it down, but maybe also Eiko and Alvise want to chime in. I think there's, at least from my view, there's two angles to this. I think the first one is indeed that if you cannot crowd in private investment, it will not be enough to increase public investment. If you look at total investment in Germany's economy, it is predominantly private investment. The only meaningful share you see in the public sector is actually the stuff I mentioned. So bridges, roads, railway, to some extent also digital infrastructure. So everything else, real estate, factories, is usually solely financed by the private sector. So this cannot be done alone. I think this is clear. So I think that's the first element, is that it needs to be crowded in. I think one element that would help if the public sector has a very clear and multi-year plan of what technologies are at stake. and for that reason, sort of create a framework for private investment to also, investments typically follow a multi-year project stage. So you plan, you build, and then you finance. So I think in that sense, if we have more predictability and clarity, which has plagued the traffic light coalition over the 3 years of its existence, I think that is already much of the way to actually finally mobilize private investment. Of course, there's other factors here to ease also startup finance, to ease more risky capital to actually be mobilized, and this is clearly where then capital markets union and other elements come into play. And I'm sure what you say is Merz's connection to those parts of the financial industry will certainly help. I'm sure.
Yeah. Okay. Now, if public investment does increase significantly, here's another, potentially another, they're all loaded questions today, but are there enough skilled workers in Germany, or would labour market restraints lead to wage increases? Which is a pretty pertinent question.
I agree. Let me give it a try and again pass over if there's other views around the table. I think, yes, there's clearly a labour shortage in selected sectors. No, I think what we've seen is that with the labour market cooling, we have seen unemployment take up a bit in Germany in recent months. Let's say open positions in selected industries have actually also come down. So you could say that the tightness of the labour market has actually reduced in recent months, and that has to do with economic slack, of course, with Germany performing rather in a stagnant fashion. But I think long term, we all know that that will only resurface. So especially in IT, but also long-term care and other sectors, there's clearly still a shortage of workers. And as Eiko had mentioned, this will only be exacerbated by the demographic shift. So I think one element that cannot be underestimated is to make sure that foreign workers come to Germany, are integrated quickly into the workforce, and that there's many ways to change the framework here. There has been some measures taken by the outgoing government, so they have not been asleep on this issue for sure. But I think more can be done, especially also with Germany's image abroad, that it actually welcomes those workers and as Eiko says, maybe work on the tax wedge, for example, to a degree to also make it more competitive internationally.
I don't have much. I don't have much to add, but maybe just as a quick one. I mean, it's a very good question in the sense that simply throwing more money at it obviously doesn't mean that the workers just magically appear. Yes, completely correct in terms of what Julian was saying, that I think this is why migration policy is so important, especially against the sort of political environment where there is appetite to restrict migration, which I totally understand. But in terms of skilled migration, this is really something that Germany needs and will need, not just in decades' time, but in the next years as well.
Yes, indeed. Now, if we do get higher spending, I've got a question about how do you think it will be funded? Will we see more bond issuance, potentially at the federal level or at the lender level? Just let me throw that one out there to anyone who wants to venture a response.
Yes, I'm happy to start. Yeah, sure. Yeah, very happy to start. Yes, I mean, in short, the answer is yes. I do expect that there would be somewhat more bond issuance, especially, I mean, the 200 billion for military spending. This is money that would be raised on financial markets. So here we would clearly see more bond issuance for this. Also, any sort of relaxation in the debt brake could also potentially lead to a little bit more bond issuance. And in terms of whether this is at the lender or federal level, I mean, one topic that has been discussed, which I think there's also some appetite from the CDU, CSU, is to ease the debt brake, perhaps at lender level, who are facing an even stricter debt brake than at the federal level at the moment. And perhaps to allow a bit of a cyclical component that allows them to borrow a little bit more during economic downturns. This could also lead to a little bit more issuance at lender level, I think.
Yeah. Okay, look, I'm conscious of our time, but there is one question that perhaps, because Alvise, I think we're going to lead on with you in a second, but it's a question which is incredibly pertinent to us today, particularly as a rating agency. And the question is this: what might looser fiscal policy and debt brake reform mean for Germany's AAA rating, which is potentially a $6 million question? So
it is indeed, yes. No, I think the good thing is that we have been asked that question actually many times over some years now, because there have been many instances where there have been more special funds, more borrowing, etc. And I think, as we have said before, obviously conservative fiscal policy and the low debt ratio that I had shown on the slide just a second ago are all credit positives for Germany. So that goes without saying. I think what I've also tried to explain is that there is fiscal space at the current credit level. I think especially, so if I did that simulation calculation, that actually was quite conservative because we didn't assume higher growth. That would lead on after higher borrowing. Obviously, there will be some fiscal multiplier if you loosen fiscal policy. And that, again, that needs to be looked at very carefully to see what quality does that investment and higher borrowing actually have, and what does it mean for our sort of fiscal calculation. So I think we will obviously watch this space very closely. But again, if I repeat myself, I think there is a degree of fiscal space at the current credit level.
Yes, and I guess just to add here, it's certainly, despite these domestic challenges, it's certainly our baseline that Germany will remain the economic and financial anchor of the euro area and the EU. I think that's and that certainly also underpins our credit view on Germany.
Okay, cool, thanks. So why don't you just pick up here, Alvise, and go into your section?
Sure. So I guess, I mean, we've talked about the domestic challenges that Germany faces. I think the geopolitical ones are just as significant at the moment. And I think the key question really is whether Germany is willing and able to increase its security and defense expenditure. We've talked about that there are discussions about creating this special 200 billion defense fund, which really matters because by the end of next year, the 100 billion defense fund will be depleted. So if the 200 billion defense fund is adopted, Germany's defense expenditure over the coming years would increase by slightly more than 1% of GDP, which would bring Germany's defense expenditure level to around 2.5% of GDP. And to put that into context, that's essentially close to where Germany's defense expenditure was during the Cold War. Now, if the fund is not adopted, reaching the same expenditure level on defense would mean that about 25% of Germany's budget should be spent on defense. And politically, this is very difficult. So we will see how the parties, how the discussions continue, but that there is certainly a willingness and a need, I think, is clear. Now, given the magnitude of the challenge, with or without the fund, we also believe that actually the next German government could be open to consider some form of joint financing at the European level. Now, there might be an interaction here. So if the defense fund is adopted, the 200 billion, the German ambition to finance this at the European level could be lower. But there could certainly be an avenue for Germany to also play a constructive role here. Now, what are we talking about in terms of the needs at the European level? I think, and this really comes down to obviously in response to the shifting US policy and foreign security stance. And I think, the European security needs, in many ways, they come down to three questions. One, how are national defense budgets going to evolve? Key question here, the German defense fund. Two, how much money is needed to build the necessary capacity to deter Russia? And three, how much financial commitment is needed to appease President Trump? Now, these three questions, they don't have clear answers, and they're probably evolving. But the numbers that we've seen range between about 100 to 300 billion of additional defense expenditure that is needed at the European level each year. Now, that's a lot of money, but for a continent as rich as Europe, 300 billion is feasible. It's about 1.5% of GDP. But the real question is therefore, what really matters also for us as a credit rating agency is this burden sharing, because the fiscal space between member states in the EU is vastly different. So German leadership here to strike a new balance between financing defense at the national or at the European level is actually also critical to ease potential debt sustainability pressures of other member states. And at this point, we're not even talking about financing the reconstruction of Ukraine. This is really just about security and defense. Now, just to conclude, how could this joint European defense funding look like, and what could Germany's position really be here? So, in principle, there are two broad avenues to go about this. One could go about using existing infrastructures and institutions, for example, the European Commission, the EU budget, or also slightly amending the mandates of other European supranationals, such as the EIB or the ESM. Or you create a new dedicated fund or vehicle to address the defense expenditure needs. Now, from our point of view, there are three very critical things that need to be considered here. The first is that however this is financed, it ought to be with dedicated resources. So shifting at least some part of the European defense to the European level is not for free. It requires dedicated resources. And certainly the German position at the negotiation that the Friedrich Merz government will take will be critical in terms of whether this implies reducing expenditure elsewhere at the European level, or whether it implies adding new taxes. And these will certainly be hard-fought negotiations. The second is that defense, at least the way we see it, is not a one-off. So it's not a COVID shock that happens and dissipates. It's actually a permanent need. And therefore, the effort and the institution or vehicle also ought to be permanent, which would also address one of the key drawbacks of the Next Generation EU program, which is set to expire next year. And finally, Germany's, but also frankly Europe's defense financing and military security would very much benefit if there were an opt-in for the UK and Norway. So our baseline is that given the magnitude of the challenge, the German government will play a constructive role in this stance. Certainly this will not be easy negotiations. It's about the design and financing of the European security architecture. But overall, given the domestic and the geopolitical pressures, we think that that Germany will essentially rise to the occasion. Simply also because Friedrich Merz himself noted just after winning the election, he said that achieving European independence from the US is an overarching goal. And that geopolitical pressure, I think, is what I think makes the three of us at least cautiously optimistic that we are at an inflection point. But also happy to take your questions on this.
Yeah. Thanks, Alvise. There's just, as all topics we've discussed today, there is an array of questions that you could potentially throw up around each of these subjects. But I think you've kind of covered this, but I just want perhaps you to clarify. You talked about burden sharing and joint borrowing. Just focusing on Germany, does it make sense for Germany to finance defense at a European level rather than for itself? In other words, I mean, wouldn't it just be cheaper for Germany just to do it on its own?
I mean, that's obviously the key political question and a financial one. I think we have to consider several things here. So politically and I mean, security and defense is a clear European public good. So Germany on its own cannot guarantee Europe's defense. It will need the support of other member states, especially France, but arguably also the UK. So joint financing of the European architecture is essentially the appropriate lever because it's a public good. It does not just concern Germany. And I think one should also consider that the cost of defense actually increases the more fragmented the European military is. So joint financing could actually facilitate greater military cooperation, and that actually reduces the cost. Now, and that if we take a longer term view, the European defense market is very fragmented, as we heard before. So building a European defense market and procurement system would actually also lower the cost, including for Germany. And this, the economies of scale that one can think about here are certainly greater than the ones at a European level than the ones that the German government on its own could achieve. And finally, I mean, financially, is it the benefit for the German taxpayer? It goes for, this is the same question that you have on the EU budget and the European supranationals, because certainly the Bund is cheaper than and trades lower than the European supranationals. But I think that there are certainly ways that other member states could compensate Germany for this. So I don't think it's a matter of financial possibility. I actually think it's a matter of political negotiation. But certainly one can design and think of mechanisms that would compensate the German taxpayer for driving and supporting this joint defense funding effort.
Yeah. Okay, thank you for that. Look at it. There's a very short question here with a potentially very long answer, but given we're getting close to our hour, perhaps you could just perhaps summarize Alvise. But look, I mean, the question is very simple. What can Germany do about US tariffs? Which ties into the whole question. You talked about achieving greater economic independence from the US at the European level. What can Germany do?
Yes. So, I mean, the tariff threats, they come and go. And I would actually make the case that they are actually linked to Germany's efforts to finance security and defense. So if Germany does step up and if Europe does step up on financing security and defense to a greater extent, the risk of a full-blown EU-US trade war is probably lower. So I think here, Germany assuming leadership is actually, on the security and defense side, is actually likely to also have positive impact on the threat of tariffs. Now, you could also say that tariffs could come nonetheless, simply because of the uncertain nature of the Trump administration. But if they were to happen, I think, I mean, we've also commented on this before, there are surely things that the German government could do. The most important one for us, I believe, is actually to implement the reforms that have been laid out at length in the Letta and Draghi reports on deepening the single market, simply to boost intra-EU trade. So that in itself would already be a huge offsetting policy measure. And here, a German government could actually really push these reform efforts. Similarly, obviously, this falls under the responsibility of the Commission, but the German government could also support European-wide efforts for additional strategic free trade agreements. We've seen Mercosur being signed, but you could also think about deepening trade relations with Canada, with Japan, India, etc. And this will essentially help reorient trade, or in that sense, reduce the negative impact of U.S. tariffs. But needless to say, for some German companies, especially on the industrial side, the best option for them might actually still be to shift some production to the United States. And if that is the case at a micro level, at a company level, in this regard, there's very little the German government could do. And that's ultimately part of the US strategy, to create this uncertainty so that it is actually in the interest of some companies to shift production to the US. But still deepening the single market, strategic free trade agreements with other jurisdictions, and addressing all the reforms that Eiko and Julian have talked about to boost Germany's competitiveness. That's actually the best response. So focusing on what one can do, that's clearly the best response for the German government on tariffs.
Yeah. Okay, so absolutely makes sense. Look, I think that I have come to the end of the line of questions, and we are close to our end point. So I think we should close the session there. So I wanted to thank Julian, thank you very much. Alvise and Eiko, thanks for your comments. I think some great answers, some incredibly sort of open-ended, broad topics. So I hope that's given you, our viewers, some food for thought. And let me thank everyone who dialed in to watch and look at the numbers. I think we had a pretty high retention rate, so that speaks volumes as well. I did say at the beginning I would explain how to download this slide presentation. And so if you, at the bottom of the screen, you'll see an apps button. You click on apps and handouts pops up, and click on handouts, and hopefully, all things being equal, yes, there we go. There is a slide presentation, and just obviously click download if you wanted to take it away with you. So we are clearly in at a very early stage of this whole narrative, and depending on the direction of travel and what happens, as I mentioned, so many moving parts here. As sovereign analysts, Alvise, Eiko, Julian, and the team are watching all of the moving parts very, very closely. And depending on the turn of events, we will certainly, potentially, I say, we'll come back and do another session at an appropriate time once we've had perhaps time to see what actually happens. So please watch out for that. Once again, thanks for dialing in. Thanks for all the comments today, and thanks for the questions. And we will see you next time. So it's goodbye from us.
Thank you.
Thank you.